All right, let's jump to something else. Anatomy of the trade. Oh, look where we are with this trade. So we have two solutions, and I want really quick decisions here, guys, because I don't want to spend a lot of the class time on this anymore. We could continue with this talk, which I'm totally fine, and we just gonna analyze it and take any available trades until the end of the semester or going into the next semester that this stock is going to give us. Or solution number two, pick another stock. One of the proposals was to pick the stock also in the same group, so kind of like with the same theme, and we could definitely do that. Or we could go to a completely different stock. So with that, let's do a quick vote. So just say yes or no. SunPower, continue with SunPower or not continue with SunPower? Yes or no? Please vote. Okay, all right. 5 more seconds. Do you want to continue with SunPower or do you want to go to another chart? So say yes if you want to continue, say no if you know. Okay, so it's definitely 80% no. People want another chart. Okay, great. Next question. Would you like to stay in the same industry group, the renewable energy? Yes or no? Would you like to stay with the renewable energy? Yes or no? Okay, so this one is a little bit harder. So let me just count. Okay, so this one is actually 50-50. Okay, one more vote. Whoever votes right now, who did not vote. Okay, so no. All right, so we're going away from this for this group. Okay, so then we need to figure out the way how to select the stock. And in this particular group, because you guys, are more advanced, I would be assuming that, this process should be easier for us. Think also about how much time we have left. So we are October, end of October, so we had this is session number 7. So we're in the middle of the class. We still have about 2 months to trade the position. So this is probably a swing trade that we want to initiate, that we want to maybe go about. So think about the stocks that have that momentum characteristics. So we want to find the stock that's going to do something like this in a month or two, right? Where it's not necessarily going to do this. Just going up is not enough. We want to find the stock that is going to have this momentum characteristics. So candidates, and we could look at those right now. I see a first candidate for us that comes from Dmitry, so let's look at that. And then we could vote. Maybe that's how we're going to go about it. Kind of an interesting process to do that. Okay, so this is in energy, exploration and production. And I love this pattern. Definitely a very interesting stock. Looks like on the backing up action, right after phase C. I love the minus sign of strength in B here. And now in this backing up action. So great, but it looks more like a campaign stock. Would it travel here? Well, actually, it might travel the same way, right? And by the way, why oil would go up? Why would an energy stock have an increased volume characteristic? So on unbalanced volume, it's going to look like this, and then have higher highs and higher lows. And the macro view is still going to be negative on oil and on energy in general. Well, because they are buying at the point of price depression and bearish sentiment. That's what they do. Yeah. Okay, so why don't we do this? Let's vote for this stock, yes or no. And then if this stock is not being voted, then we're going to go to the next submitted symbol. And we're just going to go until the point where everyone agrees. Okay, so please vote on this stock. This is Crescent Point Corporation. I actually had just a recent position in this stock right here. I caught this move and got out, on the swing out. Actually, it moved really nicely and very quick. Has a point of entry right now. So, I mean, Dmitry, I think I'm with you on this. I think I understand what you're thinking here. My problem with this probably would be almost none, with an exception of maybe just like a small analog here. What kind of rally we could expect here. But we could analyze this a little bit more. This would be a homework. Okay, so let's look at the results. Okay, by one vote, unfortunately, we didn't make it, Dmitry, so I'm sorry. Okay, let's go to the next one. So it's kind of fun. Okay, the next one is Bitcoin. So, and obviously, guys, we're gonna vote as well. Let's look at that. Let's look at the Bitcoin really quick. Here we are in the Bitcoin. All right, well, let's vote. Let's not wait. What do you guys think? Oh, you can't see the chart? Oh yeah, what's going on? All right, hold on a second. Hmm, strange. Okay, you should be seeing it now. So here is a Bitcoin. Let's see what you guys are saying. Okay, so definitely no. More no's to that. Okay, next stock. And let's just definitely pick up the stock. Trade Desk. That's the next candidate. All right, so definitely a lot of momentum, close to the moving average, long-term moving average. So something where we experienced before a stop in action and a trading range. Okay, let's vote. What do you guys think? Would you like to trade this stock until the end of the semester? Okay. 5 more seconds. Let me know what you want. As a swing. We're trading this stock as a swing. All right, so we're gonna close this out, I think, right? So you guys are saying that this is the stock. Yeah, so finally we found something that, let's say, at least the majority agrees. So some of you said no. So let's just, guys, kind of like go with where we are. So for the homework, let's analyze this stock. Please send me your bias game and also your analysis of the trade desk. And then next class, we will discuss where we are. Again, remember that we are looking for kind of like 1 to 2 months trade, which is a swing trade. That's our goal. Could be both on the upside and on the downside. All right, great. I'm happy that we're done with that. A question from Ronnie, and that was on SunPower. If possible, and if it feels okay, can you share the view that you would see as a good time frame to look for a positive test on spring, LPS, or reversals? Is it correct for me to assume a commitment above the white line? Okay, so this was the line right here that Ronnie had. A commitment above this line uh, would be a positive sign for entry, assuming the analysis bias and everything else makes us believe it's accumulation. Would it be better to wait for the test that is big enough to show on the daily charts? So you can actually do both. On the intraday, and this was the top of this latest attempt to upthrust in kind of like this smaller distributional pattern right here. And look how much momentum we have to the downside. So don't go into the first rally after such increase in the momentum. Don't do that. It's kind of the same conversation that we had on the bias game chart, where a very strong rally suggested some kind of continuation of the absorption of that selling. So, and you would be rewarded because right away we see some more selling, some selling, exhausted selling, and then we're thinking there's going to be another attempt. And here it is. And you can trade this, and you could actually trade both places. But I think that Ronnie has a very solid logic here. Waiting for a daily confirmation definitely gives us a much higher probability that the swing has been reversed. Having said this, the intraday points of entry would give us the best possible entry point on the price itself. And if you're thinking of using some kind of mechanical ways of identifying how to get into the position, and you're using some levels and the breakouts, this still would work, but you would have to think about the exit, your exit strategy. How do you exit the stock? So probably after the reversal, so I'm not sure if we would reverse here, but we definitely would reverse here. So something like this. This could be a trade if the pattern fails and if it doesn't go up. As you've mentioned here, this could be a point of entry, and then this could be an exit, and this would be a trade. And in both cases, it could be even a break-even trade, or you could develop also some methodology where you are kind of getting out on the momentum, on acceleration, and not anticipating, a continuation. You can do like one half exit, and then still continue with the trade, and then exit on the reversal bar, something like this. So use daily more as a confirmation of a much longer trend, and use intraday just to initiate some points of entry, add-ons, scale outs. All right, great. Okay. Let's talk about the position size. I think that we did talk about this in the WTC course, but I just want to make sure that, we've covered that. This chart is kind of like showing, and I borrowed this, I thought it was from Ed Secoder. Now I'm thinking it's probably not from Ed. So basically your optimal spot, not just on the performance, but in terms of the size in itself, is going to be, that bell curve where if you're increasing the size, it's going to increase the risk. If you're not in a full sized relative to the risk, then you're not optimal. So you need to find this spot for yourself. What is it? 1% of the equity that you want to uh, spend on the exploration of the bias, if you're correct or wrong, 2%, 5%, maybe some other techniques that you're going to use where you just divide your capital and then you size it up. And there are so many things that you can use. Here, specifically on this picture, we also introduce in some, performance matrix, right? Where we're talking about, mental landscape and the background of our daily, daily activities. So, are we stressed? Are we relaxed? And so that would produce specific feelings, and then obviously we could act on those behaviors and so on and so forth. So we have to make sure that as we go through those, that the sizing is correct. So we need to understand how personally we're risk averse, to which degree. We need to optimize our position size. We want to understand our position size in the relationship to the whole portfolio risk that we have. And we also want to define the position risk and therefore the position, the portfolio risk to be defined by the context of the environment and the price structure. So what do I mean by that, by the way, guys? This last point, position risk defined by the context of the environment and the price structure. Think about this. For instance, we could go through different price cycle positions. For instance, this position right here in the price cycle would be something like this, where we are at the climactic action, we are in the overbought climactic run, we are in the overbought, overthrown condition, and we would be thinking about the weight or the size for each position at this point of time. Contextually, this is not a favorable place for us to be aggressive. So we could have a definition here just based on technical conditions as to the size and exposure of our overall portfolio. And we could also size up positions, individual positions. And then let's say when we have a reaction, and that reaction, let's say -5, -10, -15, -20, like right here, this is going to be described technically as an oversold condition with emergent volume characteristics and therefore presence of the institutions. So from that perspective, this would be interesting for us to have a different sizing and position sizing algorithm at this point of time. And as we go through the whole structure, that position sizing could change, portfolio risk exposure could change as well. So just for you to kind of think about this idea, this is more of the institutional approach, how institutions are approaching the risk, and this how that risk is being structured within the price structure, so to say, but extremely useful. What if you have a small account, 5 to 10,000 net net liquidity, hard not to use 100% plus even leverage? Yeah, and I totally hear you, Dmitry. I mean, like I've been in a lot of those situations. Have multiple accounts at this point. Some of them are that small. There could be highly speculative accounts where if I commit to a position, if it works out, great. If it doesn't, moving on, so to say. And then, larger accounts, you usually do it like this. At least this is how, you know, my trading works, and this is how I'm trying to follow this. I have speculative accounts. I have two of those. And I have retirement account, one of those. So speculative accounts have different strategies behind them. And the goal here is aggressive growth. And they are smaller than the retirement account. And retirement account has the majority of the funds. And the goal here is preservation. You've earned this money, you've invested it correctly, you want to be less risky with a large amount of money. And that's why in the institutional world where people, your investors have made, let's say, big money, the big thing is preservation. And that's why investors go for the funds that have low volatility for their portfolio. So less rotation among the positions, less speculative moves, more of kind of like buy and hold type of strategy over the cycle, but with an idea that it's still going to outperform the market based on the selection algorithm. So the key here is to transfer the funds from your speculative account once you have, good trades and you have good profit into your retirement account, and just to keep kind of increasing your retirement account this way. And that's basically the mechanism that I'm using right now with my trading. Have some trades that work out really nicely, and then put that in the retirement. So hopefully that's helpful, Dmitry. Okay, Eric, I missed exactly what we were talking about, high probability setup. Okay, so Steven is saying never take a position with the risk greater than 1% of your trading capital. Okay. Let's come back here. So that's what I meant by the position risk. And then obviously we go into what Steven is referring, position size. So Steven is saying never take more than 1%. I would agree with this. I think that 2% is kind of like on the higher threshold. Let's say for any type of retirement accounts, I would still accumulate shares by pyramiding. So for instance, if I have a 2% risk that I've accumulated here, then I would be okay accumulating another 2% here just because my position will be already profitable and my stop loss is probably going to be somewhere here. So I'm not against increasing the risk in the stock that is proving me right. In fact, this is something that I'm working on a lot in my trading lately, because in a lot of cases when I'm right, I don't have a correct position size. I'm undersized. So I'm trying to be very cognizant of how I pyramid, and I'm actually a willing I would be willing to add if the trend is showing me the correct movement and the correct character. So let's go through this process. It's not very complicated at all. This is for stocks, and as we go through the reasons for entering this trade in the end of 2018, beginning of 2019, we're thinking about the context for the market. Market is in oversold condition, so therefore at least a relief rally is going to be unfolding. PayPal is outperforming, price structure is complete. We're thinking this is phase C. Kind of reminds me a little bit structurally of what we have in the market, but just in a different way, right? This is a huge structure in the market, a smaller structure. First initial volatility, rally, then volatility in phase C. But this is obviously just a much larger structure here. So enough causality, short-term reversal on the point of entry, it was at $82. So the next question is, what's the allowable risk based on the total equity and on our initial difference between point of entry and stop loss? Let's assume that we have a 100% equity, 2% per position risk is gonna equal 2,000. Our point of entry is 82. Our stop loss is gonna be somewhere here, 76. So this is point of entry. And so our risk defined by dollar amount is $6. So we know how much we can risk on this position, and we know how much in dollars the difference between the point of entry and the stop loss our risk is. So now we could go to the next point and we could say, okay, well, could we define the reward to risk ratio and then calculate the number of shares allowable for this position? All right, for the reward to risk ratio, we need to understand what the reward is, and our PNF target was at $122 as a minimum count. Oh, by the way, did it reach it? I wonder. I have not looked at PayPal recently. We are taking that target and taking the point of entry, so $40 until our target. We take that $40 and we divide it by the measure of risk, $6, and we have the ratio of 6 that equals 6.7. This is more than 3-to-1 reward to risk ratio, so 6.7 is a really good rate for us. We definitely would consider this position just based on the risk parameters. And now, how would we calculate the number of shares? Again, we're taking that $6 risk, and we are taking also $2,000 risk that is defined on 2% of equity that we're willing to risk each time on the size that we have. And we divide that 2,000 by $6 risk, and we could get 333 shares at this price with this risk. Now, a big question here, what if the price gaps to, let's say, $70 the next day after the point of entry? Well, this would mean that our risk is going to increase by the factor of 30%, about $2. Hold on, $2 below 76, no, by 60%, right? So instead of, let's say, 2%, we will have the loss of about, I'm just approximating, guys, so maybe I'm going to be wrong, 3.5%, about. So that's way above, let's say, 2% that originally we were willing to spend. But think about how many of those situations you're going to have where you have those gaps against you. So this year, and I have those each year, I must say. This year I had, let me quickly think about this. I probably had one, maybe two, but those happen. But on the number of trades, let's say per year that you have, this is going to be a minimal number. And you could even historically go back to the previous years, let's say take the last 3 years as a better measurement of where you are with your acutement of on analyzing the stocks and executing, and use that as a reference. How many stocks will get down like this on you. And you could calculate what are kind of like the probabilities of the of a loss like this. It's going to be probably more minimal than you think with your knowledge increase and with your skill increase. That's how we would calculate the position size, for stocks. If you are using leverage, you could increase your equity size. If you want to use, let's say, 1%, so obviously this would change to 1,000. Or if you want to increase that, you could do that as well. You could put this into the into the Excel spreadsheet and just have this algorithm, coded there. Somebody was commenting on the PNF. Yes, it's useful to calculate, approximate the target. I'm not even going through the whole structure. I just want to know what is the most minimum target that I could have on the PNF that makes sense to me. And it looks like within this structure brings us to 122. And now I'm looking at the numbers that your guys are posting. Michael is saying, okay, PayPal hit a high of 121.48 on July 16th. So we came literally, within like 50 cents, 52 cents of this target on July 16th. That's uncanny. And that would be the trade. It's not necessarily that we would be getting out. We would be looking for the signs of short-term distribution, reversal, stop in action, and so on and so forth. How would we be dealing with this if we have options instead of, let's say, cash position? Okay, well, these parameters are still going to be the same. The equity size, the risk per position, 2,000, point of entry, and stop loss as well. We just don't necessarily need to understand the risk in terms of the dollar size. If we're entering an option position here and we're entering directionally, so we are buying a call, then this purchased and therefore our risk is defined by the premium of that call. So let's say that the premium of that call would be, let's say, $5. So at $5, we're going to be spending a price on the option. We're going to be spending 500 to control 100 shares. And this would be our maximum risk. We can allow this option expire worthless, or we can sell it as it loses value and still collect, something back. But our maximum risk is going to be defined by $500. So within 2,000, we could have how many options? 4 options. And we would control 400 shares with these 4 options, which is slightly more than what we would with cash. Obviously, we are going through the risk controls here, but, when you use options, you need to consider the time duration and, how the option price is going to change just based on the volatility, time, and, some other factors. All right, great. Let's see where we are. Almost 5. All right, great. Let's go into our exercise. Good time to start the exercise. This action sequence is going to be on the selection and also on the price and volume analysis. I'm presenting you 4 stocks, 4 selections. I'm going to give you some time to think about these 4 stocks. I want you to analyze them. Think about the structure, think about the volume and price analysis, think about comparative analysis, and then write down 1 stock out of this 4 stocks that you think is going to outperform all of them. And let me give you maybe 3 minutes until 5 o'clock to think about this. And I'm going to mute myself, guys. All right, guys, let's have a look. Any more answers? Which stock would you guys pick? All right. Okay, well, we have 3 answers. We have stock number 2, we have stock number 3, and we have stock number 4. That's probably not a surprise, right? Because here we have an uptrend, here we have an uptrend, here we have an uptrend, and then higher high and higher low, so still kind of like in this upsloping structure. And here we clearly have a downtrend. Okay, so what I would like to do is, and by the way, the majority of you said stock number 3. So what I would like us to do is maybe just to go through these stocks really quickly. And please give me the reasons for those of you who said, let's say, stock number 2. Give me the reasons of why stock number 2 would be a potential outperformer here. So write it down, kind of like bullet points. And I'm thinking here, okay, stronger than 3. Okay, so where exactly stronger? So we have the same type of the reaction. This move to the upside in the stock is stronger than this move, although we'll have to see what. Just on the comparative basis, let's just quickly see. So we are, what are we doing here? What are we comparing? We're comparing this high. This is a long-term high. That was in July. In July. Okay, this, and then this one here. This one was in March. Something like this here. Okay. We kind of have a still short-term outperformance by stock number 3, I would say. I mean, if we would be looking at, let's say, oh, I see what you mean. Oh, this rally right here. Okay, got it. Okay, from April to June. This is late June, right? So late June would be here. Okay. Yeah, okay, I could see that. Yeah, there is a little bit of outperformance here on the way up, but not necessarily on the way down. I don't think so. Maybe a little bit. Yeah, a little bit. Okay, well, even if we have this outperformance, what happens here? Are we outperforming here? Um, Probably not as much. I would have to like go point by point just to come to the conclusion to this. But there is something about stock number 2. Let's look at stock number 2 in more details. What do you guys see here? What is the character with which the price moves? And I definitely see the point here about this reaction being less than this, and this, and then this reaction is also not being that much. I think these are all great points here, and we would be expecting a continuation to the upside. Actually, all of the stocks went up to the upside after that point. We're just trying to define, a selection for us. What is that one stock? Okay, so look at the character with which the price moves up. What are you guys saying? Okay, increasing volatility, moving up with less supply. The reactions kind of dip, and they have those gaps, volatility type of reactive behaviors. Look at even like this reaction right here. 1, 2, 3, 4, 5, 6, 7, 7, or maybe even more times. There was just like push down, push down, push down. Look into this stop in action. Look at the size of the reactions. You could be thinking that this is an upsloping structure. You could do that. There are some elements of stop in action here. So therefore, this would be a buying climax area by itself. Change of character, we see that from the volume signature and the gap test. Phase A, B, B, C, and then we are in D. And D behaves exactly how we want it. So yes, there is a lot of logic here as to why this selection. But again, it's just that character with which there are so many spots where the stock is just being sold so aggressively. There's with so much volatility that is not as attractive. Maybe as not as attractive as stock number 3. Let's go into the details for stock number 3. Stock number 3 moves very nicely to the upside, and we can observe that the momentum increases, the volume signature increases, we are overcoming the price highs, we are committing to the upside, we are reacting in the non-threatening, non-aggressive ways, and our reactions stay that way until we actually have a final climactic run with the final gap, change of character bar. This was also a change of character bar, but nothing happened. This one actually follows through. So this becomes a change of character, and then we know that we're going into a trading range. Throughout this trading range, we are in the downsloping structure, so our sign of strength is this, and a backup, phase C, and a nice continuation. The majority of the momentum came on the initial sign of strength, continuation, and usually we're going to see that momentum confirmed by the volume signature. And this is what November special is going to be about. It's just to looking for those patterns where we have that initial momentum kick out of the structure, and that's confirmed by the presence of the institutions. And then the key for us will be in November special to define also these moments. Where would be reaction go? Well, usually after the initial momentum kickoff, we're going to see, let's say, last portion of the upswing with less volume signature, less demand, less buying. Therefore, momentum is going to fade. And it's into the area where the late buying was happening. This is where we would be expecting the reaction to come. And this is where we would be expecting the reversal to happen. And I'm going to show you a lot of examples of this type of relationships between the momentum as the function of institutional presence and their increased effort to push in the direction of the bias, and how that plays out in the structure. So hopefully that's going to be useful. All right, well, majority of you said stock number 3. I would probably be thinking about either stock number 3 or stock number 4. If I would be choosing only one, stock number 3 would be my candidate as well. Why am I choosing it? Because I clearly see that institutions here are very dominant, and that the uptrend is very dominant. It's stable, it's defined. There is really not a lot that is happening in this uptrend in terms of, a heavy distribution. Every time we have high volume signature, there are ways of how the price manages to reverse itself, observe that supply, and specifically here we see an emergence of the supply, and look what happens. The price actually creates a higher low. There is a lot of momentum behind this rotation, so we would be expecting maybe a slight continuation, maybe a slight retest, but probably rapidly the price could leave this trading range. Also, in the middle of the chart, look at the bell curve that we see here. That also tells us that institutions were getting into this position heavily, and they added to this position here as well. And now, if we're looking at the value zone for this point of entry, so we're going to say that this is where they were buying, and then the price quickly came down to the same value zone, and they bought in again. So there is a lot of buying throughout this whole structure, and then there is a confirmed volume as a buy again, as an add-on into the value zone again. So I think this is a really good candidate. Let's talk about stock number 4. For those of you who have picked stock number 4, give me the reasons why you think that this stock is going to outperform. This one is very interesting. Why would it outperform? Okay, so let's look at this. It broke the downtrend. Indeed, it did. Large cause build. So I'm assuming this would be the cause. High low. All right. What else? We look at the volume signature and we're seeing like diminished volume characteristics here going into the last reaction. So volume is going down, suggesting supply is going down, suggesting some kind of rally. Well, we know that, yes, all of them are going to rally. Now look at how aggressively this rally starts. Does this remind you of anything? Analogs? Okay, well, let's look. This analog here, the bar is this one. So we see that there is slightly less effort pushes the price up. Does it push the price in the same way or in a different way? Obviously it breaks the trend. What do you guys think? Effort is almost the same, slightly less. Pushes the price easier or harder? Same way, urgency to buy. Yes, we see the urgency to buy, but we want to define the level of resistance of the supply, and the way how we can measure this is by the progression of the price. We have the same analog, almost the same analog effort, so how would we measure this? Okay, let's look at this. We could measure it by the distance traveled. I'm taking the true range because in both cases there is a gap. That probably would be still less accurate because the volume signature does not belong to the gap. The volume signature on that particular bar does not belong to the true range. It belongs actually to this whole body here. So I probably would just take the gap itself and just say, okay, 50 cents here on the gap. What's the gap here? From about 17 bucks to, what is it, 17.80, maybe 85. So maybe like 80 cents. So which gap do we like more? Obviously more bullish. And we're looking here for the definition not of bullish. We're looking for the definition of better, more bullish, moves better. I'll tell you why in a second. Okay, so much better gap in the second case. Let's see if the movement of the price is much better in the second case than in the first one. So we're traveling here the range, and I'm taking the high and the low, approximating 1925 and maybe like 1760. So that's what is it? 60, 1760. Okay, so 18, about 185, just about. Okay, and here we have maybe 1785, and here the low is about 1670. So $1.15. Here's a quantification and algorithm to calculate the velocity with which the price moves on the volume signature that is analogous to each other. Again, something of a preview for the November special, something that we'll talk about within the context of the momentum, because we want to define the momentum and how it moves, right? Arvin is saying, do you compare absolute or should we compare in percentage terms? Because the price is very close to each other, we don't have to think in terms of the percentages for the complication of the calculations, but you can definitely do that with the different scales. And usually analog bars are supposed to be somewhere in the same price zone. Otherwise, you might actually compare not apples to apples. Well, in this case, we see that gap moves faster. And then on slightly less effort, the price moves more, suggesting that the price moves easier than in the first case. So what does it mean? It means that we're probably going to have a rally that's going to be better than what we've seen before. And if that's the case, then the rally that we're expecting is going to be at least from $15 to $24. So that's going to be $9. So we probably going to overcome $30, something like this. And then if the analog is going to work, we're going to still have a continuation of the rally. So we want to understand how we would trade that. So any type of small reactions would be something that we would consider actually entering and thinking about, some kind of continuation. One other thing before we jump to the next, to actual, the results. We've talked about how the momentum bar defines the ease of movement and character, possible character. It gives us the distinction on the character. I'm still struggling with some of the people that come to me and they're saying, what are you talking about with the character? How could you define the character of the next move? It's impossible. I understand the sentiment, but I see what I see, right? So I see that this movement is easier. So that suggests to me that supply is more observed at this point. I could confirm this with the volume signature, but I also could see this in the reaction itself. Look at how analogous reactions developed. A lot of volume, a lot of sell-in coming in, a lot of volume, a lot of sell-in coming in. And then what happens? Some kind of pause. And then we have more or less this laborious way to the downside. That's what defined actually the rally itself. They were buying on the way down, on the way down, on the way down, and then on the way up. Kind of the same pattern happens here. They were buying on the way down, on the way down, on the way down. But look at how much less supply we have compared to what we've seen here. So the level of supply is less as well. And that's why this momentum, is much more dynamic. And that's another thing, that we'll be talking about in November special. So it's going to be an interesting series. So again, we would be expecting a dynamic rally from here, probably analogous to what we've seen, overcoming the 24, probably even going to around 30 bucks. Again, I think this is a much difficult stock to trade because of the volatility to the upside. It might not give you like a lot of points of entry. Stock number 3 is probably the best. Shows you most recent absorption, the test, attempt to break out, kind of like a perfect spot to get in. Stock number 2 suggests a continuation of the uptrend. Um, has some short-term elements of the outperformance. I like how volatility is kind of almost out, but still, even here, this type of spikes like this are kind of a little bit uh, cautionary for me. And I would say that this trend is going to unfold with less intensity and supply still going to be present. And then stock number 1 is very interesting because we have a lot of volume coming in, so institutions are present. That is being reflected in the momentum itself. And that is such a big momentum change from what we've seen before on the way down. So that suggests a change of character, and we are definitely in phase A. We're probably in some kind of trading range formation at this point. We just don't know where is the boundary for the resistance because this momentum cannot stop right away. There is no selling here. So therefore, there might be continuation above this level, and there is a swing trade that is hidden here. Percentage-wise, this could be the best trade for short term. Why? Because of the most current development by the momentum and how continuation is going to happen also very quick. But I think long term, it's either stock number 3 or stock number 4. Also, other observations here. Where would we potentially be looking for the target? Look at the extreme oversold condition. And this is not just a short-term oversold. This is also a long-term oversold. Look at this downtrend. Uh, and because of that, we're thinking that the price is in the extreme oversold condition. Out of the extreme oversold condition, price always quickly will bounce up to what was perceived before as the fair value by institutions. So we would be expecting our target somewhere here. Plus, considering that the price might move really fast, continuing the initial momentum, this could be a very good short-term trade. Would probably have something here short-term, just like for a week or two. Would definitely have an overweight in stock number 3. Would have a position in stock number 4, but depending on the reactions that are going to come after this level. Let's look at what happens next. Okay, stock number 1 was Apple. This was happening in 96. Here is that first reaction to the upside. Again, look at the momentum of the deeply oversold condition that we have here that moves the price so quickly. That type of momentum suggests a continuation. And I said maybe like 2 or 3 weeks. I think I'm wrong here. Duration was much longer, but we did come to the value zone. So probably in this trade, just thinking more about the duration itself. Although we were right here, so 2 weeks would take us to the higher ground. So maybe somewhere here. Actually, not bad. Still would be a profitable trade. Stock number 2, we were right here. And again, it's just the nature of how the stock moves with a lot of stopping actions. That is counter to the whole trend that we have. So it's almost like there is somebody that always is going to sell into the strength, sell into the strength. So what could we expect? After the point of entry, a very quick sharp move. I don't know how we would behave there. Our stop loss would save us, most definitely. But then again, sharp move here and a change of character, and not such a profound continuation. So still, a good profit, but not as much as, let's say, stock number 3 or stock number 4. Let's look at stock number 3. We were here. We said that this increase in the volume signature was very fortunate for us. Why? Well, because it shows the increase of the supply, but it also shows that demand is there by the volume spike and the way how the price reacts to the high or low, how it initially bounces up. And we're thinking that there might be a quick absorption on the way up. Usually that type of pattern means that the price goes up to the previous resistance point and then consolidates in the upper part of the range and then comes out with a lot of momentum. So that was very fortunate for us to think this way and think that we might have some kind of acceleration. This was a great run. This was in Microsoft. And until probably this point right here, you had no hesitation of staying in this trend. Stock number 4 was interesting, and we said that we need to see some kind of small reactions like we've seen on the previous upswing. So here is one, here is another one, here is another one. So that would be a point of entry for you if you're thinking about the same type of trade, kind of like a continuation to the upside. That you would definitely get. We were saying that our target is going to be above this high just because we are starting as a higher low, and we are saying that this rally is going to be better than the rally before. So this means that distance is going to increase, character is going to be better, and we're seeing that in the overextension. So once we're here, I think we have 2 decisions here: scale out or completely closed position. And we probably stay in, which is scaling out some, just being at the overbought condition here, and then through this structure probably going to find a way to get back into the position, especially on the breakout, and the majority of the position would stay into the climactic run. So both number 3 and 4 were great trades. I think here, we are still thinking about the availability of the supply. And then short term, I think recognition was great. Just had to think a little bit more about the duration. Target was identified correctly. All right, guys. That's it for today. That's it for this class. We are at 5:30. I think that we went through a lot of great material today on different topics. So let's just keep it up. Don't forget that you have 2 homeworks. One is a bias game, and then the second one we're going to look at trade desk, right? Trade desk, TTD. Please make your analysis of it and send it to me. Thank you, guys. I'll see you all next week. Have a wonderful week. Bye-bye.